You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Okay, so last week we talked about a long straddle in the S&P 500 index via the ETF, which is the SPY. Turned out to be a very interesting call. We're going to talk a little bit about that today. But before we get too far along, I want to let you know that we are taping Options Playbook Radio. It is a Wednesday, March 2nd, and the markets are closed at this point in time. We had a strong day in the markets in general, and we're currently seeing that the S&P 500 index was up 1.8%, trading plus 80 on the day. See the VIX index at 3074. It was down a few points on the day. And we had the NASDAQ up also approximately 1.8% on the day. So solid day from beginning to end. Fed Chair Powell came out and actually talked to Congress and answered a few of the questions. But we still have the global political issues that is still rocking and rolling, unfortunately, over in across the salts, if you will. So with that said, let's look at the long straddle. It was an interesting trade, without a doubt. I mean, the biggest reason why we talked about the long straddle, and as always on Options Playbook Radio, we're just trying to learn. It's not meant to be a recommendation, but was the fact that the VIX was actually trading below 30%. And as of right now, the VIX is actually higher. We're seeing the VIX trading right now at 30.74, even though Russia was poised to make a move against Ukraine with all their troops and forces right on the border, ready to rock and roll. So the VIX being at 28%, the attitude was more that the implied volatility probably should be higher considering what's going on in the entire world. And maybe we should buy some premium. Maybe we should think about doing that. The market was open last week. We actually taped Options Playbook Radio a little bit early on the day, and we looked at a long straddle with the SPY at 427.30. So with the market at 427.30, we bought the 428 strike put, and we bought the 428 strike call. We went out to the March 4th expiration, which I did say on the show that it will be interesting because the trade will still be live when we tape Options Playbook Radio, which is today, Wednesday, March 2nd. So we got 2 full days worth of trading. And that spread, or that long straddle at this point in time, is trading right around $12.50. If you did not trade out of a leg, and honestly, if you did not trade out of the leg on this trade, you should have received the stupid award, because the very next day after we taped, after the markets closed, Russia invaded, and the market had a really rough down day on that Thursday. So the day that we looked at the paper trade in the SPY, it was around 11 o'clock on the 23rd. And then on the 24th, the news came out, and the market opened down quite a bit on the start. The open was at 411, down from 427. The VIX spiked from 29 approximately up to 38 approximately. The low on the SPY wasn't much below the actual open. It was around 410. And then it closed, market came all the way back and actually closed at 428.30, which was just a little bit higher than where the market was at when we put on our long straddle. So very interesting. And we did emphasize in the podcast last week that you're going to want to leg out of this trade as soon as you can. And that if you're paying about 15.27 for the entire straddle, then if we could sell the put or sell the call for anywhere north of 16, we would want to do that and get out of the trade and then let the other side ride, especially if it happened sooner as opposed to later. Well, it definitely happened sooner. It happened the very next day. And the market, from where our strike was at, if you take the low, which was right around 410, so we're talking about 18 points in the money for the put option. So that put was definitely trading north of 16. I don't know how quick you might have reacted on the marketplace, but the plan was that if you could sell it for higher than 16, you would have gotten out of the trade. And especially since the market did reverse fairly quickly. I think you might have waited a half hour or so, but you probably would have gotten out of the market within the first half hour. Just why not, right? We have all the way till March 4th. So then you let the call side ride. And at this point in time, if you were to wait all the way until the 2nd of March, which is Wednesday after the close, that call option contract right now is, I should say the entire straddle is trading for $12.04. And we actually have the call option trading higher because the market right now is at 437.89. So that call is trading at a midpoint price of about 1075. So could have made money on the downside and also had potential to make money on the upside. It was a very interesting straddle, and it had not a ton to do with the chart or what was going on in the marketplace. It was more so the fact that the volatility index trading right around 29% to me just wasn't high enough considering what was going on geopolitically. All right, so that was a fun one. Next up, I think we're going to flip the script here. And I've had a lot of people say, well, the market started to come back. And, since the big downturn, we are actually higher overall in the S&P 500 index. And how could I use some options to participate and limit risk? And my answer is going to be, we're going to go the exact opposite of doing a long straddle. We're going to be bullish on the market. And I don't mind a rinse and repeat here with the VIX trading right around 30%. It was a little bit more interesting with the VIX between 28 and 29, like it was when we taped Options Playbook Radio last week. But I still think that there's more volatility to come, considering everything that's going on in the marketplace. And obviously, if you don't know about it, you've been hiding under a rock for the last week or so. So, my trade, just to get a little different, is going to be a fear of missing out trade. The FOMO trade. As a matter of fact, I'm starting to call it the FOMO trade. Why? Buying a deep in the money leap option or a longer term option. We're not going to go out over 9 months in time. Leaps just stands for long term equity anticipation security. Chicago Board Option Exchange came up with that as a marketing ploy more than anything. And we're going to go longer term, but we're going to go out till June. We're going to use the SPYs and we're going to go deep in the money and try to get around an 80 delta. That's usually our goal. The option contract we're going to look at is going to be a 70 delta, 76 delta. I'm sorry, not quite 80. And that's part of the reason why is just because of convenience. As always on Options Playbook Radio, this is not meant to be a recommendation, but we're going to go out to that June expiration date, June 17th, 107 days away. And we're going to try to manage our risk on our portfolio. We want to get long the market, but also manage the risk. And going deep in the money on some SPY options is one way to do that. So if we look at the 400 strike call option, we currently see that trading at 48.15 by 49.22. Now, markets are closed, and especially in the SPY, markets have a tendency to widen a little bit as you go into the close, and that's mainly because you have the futures contracts and the market's still trading overall, so they get artificially wide as we approach the close. But with that said, so let's call it 49. So we're making this very simple. This is a podcast, so we're talking about the 400 strike call, and we're looking at a 49 as a price, $4,900. So if I do the math on that, based off of where the index closed today at 437.89, we're talking just about 10%. Oh, well, 11%, I guess, would be a little bit more accurate, of the total price of the index. If we were to buy 100 shares of the SPY, that would be $43,789. We're looking at $4,900. So the math's pretty easy here. So we're looking at about 11%, and that's our maximum risk. We have a lot of concerns about what's going on. One of the biggest concerns that came up this week, and I think this is one of the things that did spike the VIX higher, was the fact that Putin put his team of nuclear soldiers on high alert. So that made the markets a little nervous, and it should make the world a little nervous overall. But because of that news, we did see the VIX spike up a little bit higher. It's came back down. Part of the reason why the VIX is where it is that the Ukrainians are just putting up such a solid fight against the Russians. They didn't think that that Russia was not planning that this would take as long for them to make their move and accomplish everything they wanted to accomplish in Ukraine. So God bless them. I stand strong, soldier on, hopefully. And we're going to use options to take a bullish stance on the marketplace and manage our risk on the downside. So let's review our official paper trade for this week. We are taping Options Playbook Radio. It is March 2nd. The markets are closed. The S&P 500 index was up today, and the SPY is trading at 437.89. We're going to go out to the June 17th expiration and look at the 400 strike call option. We're going to look at a midpoint price right now with artificially wide markets, because they are closed, of right around $49. That means we have $4,900 of exposure for every one option contract plus commission. We want to add in that commission also. And for every 100 shares of the SPY that you might have considered, we're going to manage our risk by buying one contract. Now, I'm going to emphasize that this isn't a leverage situation. We're not using the option contract to increase leverage, because we were going to buy 100 shares, so we go out and buy 10 contracts as opposed to doing the 100 shares. No, we're going to keep apples to apples. If our outlook was to buy 100 shares, we're going to buy a surrogate for that 100 shares. How do we do that? We go deeper into money. We get a little bit more delta, and we get some stock price representation. So I thought this was a good play off of the long straddle that we did last week. Now let's just get long the market and use options to limit our downside risk if the markets decide to go that way, if the news is worse than anticipated. All right, that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. If you'd like to know more about the Ally Invest educational events, please follow me on Twitter. My handle's at Brian Overby, at my name, very simple. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.